Hello, welcome Mavericks. This is Rob Reinhold. I'm joined by Darren, and it is the Trading Room, and I cannot believe that the first 4 months are done. They are in the books, and they actually were the worst 4 weeks that the market has seen since 1942. 1942. So we are definitely at these really extreme levels, and that's what Darren and I really kind of wanted to discuss with our traders this week, was that we are at extreme levels. And when you get to extreme levels, you get extreme movements on both sides. We still think there's some more downside to go. We came on Friday, came down and broke. We didn't have a full close below the February and March lows. I think we're going to see that. I think we're going to break through it. And then it's going to tell us, okay, now we're going to flush. Now all the people that were holding on, hoping the market held up, they're going to bail. And we likely get a bottom after that point. Now again, let's talk about a bottom. We call them tradable bottoms, just like we had in February, where it bounced back, in March, where it bounced back pretty significantly, 10%. We could easily see something like that, but we think there's going to be a lot of pain before that happens. The bond markets are pricing in 75 basis points through June's meeting. So there are 2 meetings between now and then. So they're basically saying there's going to be 50% or 0.5% in one and 0.25% in the other. Bond yields keep rising in anticipation. As far as economic reports go, we actually had a really surprising report. First quarter GDP shrunk. We were negative first quarter GDP. The definition of a recession is 2 consecutive quarters of negative GDP. One is in the books. If we, for some reason, have a negative number in the second quarter, it will go down in the history books as a recession. And that's really what the market is kind of freaking out about, is that we're now looking at, okay, is this going to actually be a recession? If it is, then a lot of things are priced too high. Other economic reports came out quite nicely. Personal income and spending up nicely. Durable goods orders up nicely. This really ties into what we talked about in our year in review at the first of the year. And we talked about what we're likely to see is the regular economy be just fine. The Johnsons and Johnsons and the people going out to their daily lives, that's going to be fine. What's not going to be fine is anything high tech. Anything tech, anything highly valued, anything that, needs financing to keep going is really going to get hit. And that's exactly what we're seeing here. So let's take a look at all the charts and the market analysis. Let's start off first with just some numbers. Ugly week. Dow down 2.5, S&P down over 3, Qs down almost 4, the Russell down 4. We had oil bounce back a little bit, and gold gave up 2%. Risk off moves across the board. So here we are on the S&P, and you can see here we have, again, the question is, where is this low? We did gap down and trade up from here, but we had 2 other points where we bounced. We had 1 point where we bounced. This is where I said, support has broken, but we need another close below this to really officially say, hey, that has really broken below those levels. We do think that is likely to happen at the first of next week. Here are the Qs. And the reason why we think it's likely to happen, because the Qs have already broken it. So there's no question that the Qs have broken the low. That's in the books. So the S&P maybe could possibly hang on if Monday was somehow an up day, but the Qs are telling us it's most likely not going to happen. Now, we don't look at the VIX all the time, but during times like this, the VIX is a really good indicator of what is likely to happen. And you can see here, it isn't until about 6 or 7 days ago that the market really started to get worried. Now, the market was lower. We've been lower the last 4 weeks, but the market wasn't worried until last week. And so now we're getting the spike up in volatility. We're up above 30. And the question is, when you get up so high, that's usually when you see those tradable bottoms. I see the trajectory is still going up here, which tells me that the market still has some move to go down. But Darren, what's your call here on the VIX in the market?
There's fear, but not enough fear. I think you call it right. There's some people that are still grasping onto hope. And until we flush those people out, until we get a margin call day, I think we continue to go down. This is there is fear, but it's not gut-wrenching fear right now.
And that's what the VIX is telling us, saying, hey, it's people are scared, but not scared enough. We haven't seen that crescendo, that peak, that what we call capitulation. So this week we think we see selling. And Monday we have the FOMC meeting. I don't think there's anything that the Fed can do to save the market here. And I think that if they say, oh, we're not going to raise interest rates or not that aggressively, I think the market doesn't want to hear that. I think the market's really worried about inflation. And so the Fed really has to come in and do exactly what the market thinks it's going to do, or it might lose some credibility. That's not going to help the market. But if the market sells off Monday, Tuesday, Wednesday, and then maybe they sell off initially after Wednesday, I see that might be the point where we do get a bounce. We have no idea if the market's going to bounce, and the market doesn't have to bounce. It doesn't have to bounce at all. But whenever you get to extreme levels, I want everyone with your spidey senses and your hairs on the back of your neck to start to tingle that say, okay, these are the moments where we get big moves. And we get them on both sides of the market. At the tops of markets, we call them blow-off tops, where we get this crescendo of everyone just euphoric and then a plummet. On this side, we're going to get the plummet and then the nice bounce back. We don't know when it's going to happen. We don't even know if it's going to happen. But what we do know is when extreme levels are reached, these have happened in the past. Next week, we've got ISM on Monday. We've got payroll report on Friday. These numbers aren't really the things that are moving the market. Things that are moving the market are the war in Ukraine, inflation, supply chain worries. That's really where the market is right now. So here we are. We are at a -3. -3. And we don't get to -3s or +3s very often throughout the year. I'm going to say maybe once or twice on each side do we ever get to a -3. But this is one of those moments where it's -3. We could see a nice drop from here to the downside. Let's take a look at some sectors.
Yeah, thanks, Rob. And I think it's pretty important to put out there. We are expecting a bounce, but you and I are not going to step in front of that bus in expectation of the bounce. I'm not going to get long anything or liquidate anything until I see that capitulation. So we were definitely not recommending to try to counter trend trade or even call the bottom here. Wait for the capitulation, wait for that crescendo, and then wait for an up day. At that point, you know that the party's over to the downside for the near term. Liquidate your shorts, take some longs in the strongest performing sectors, and then look at what's barely holding up there and look to re-enter short positions once we get the next swing high, which should be lower than the previous one. So that's one thing. Don't try to counter trend trade this, please. It's not going to be good. But let's take a look at some of the sectors right now, and you can see materials held up the best, which it's been a fairly strong one too. But consumer has just been absolutely decimated right there. It's down 7.36. Real estate, which had been holding up pretty good as well, that's down 5.6. I mean, this tells me that people they're running out of. They're trying to clip profits to offset losses, which is not a good thing to be doing. Even the professionals do it on occasion, but it's not a good thing. They don't want to book the losses in their weakest stuff, so they're taking the gains from their strongest stuff and trying to make their P&Ls look a little bit better. So this is the beginnings of we're looking at, people are trying to build up cash. They're trying to maintain that P&L so that, they can look good, but I don't think they're going to be able to do it there. So other stuff that, utility is another one that was there. But let's take a look at the individual sectors here. So we've been pretty bullish on utilities, or as bullish as you can be on utilities. But right now, I'm at a 0. We did pierce that 50-period moving average, but I want to see it close below that 50-period moving average before I'm going to get negative, go negative on that one. So utilities has been strong, had a rough week, but it's held in there a lot better than a lot of other things. And you're going to see in the sectors we're going to kind of come to the extremes. Here's communication services right now, and we're at a -3. We are at a solid -3 on comm services. And you take a look at that longer chart, you've had bounces up to the 50-period moving average, and then it immediately falls over. We had 1, 2, 5, 6 days we were above the 50-period moving average, and we just couldn't hold it. And those were pretty weak days. And now we're back down to the -3 area right here. And this looks like it could be going parabolic to the downside, complete possibility. But the times it's done it before, it's been continued to go down after that. So just be aware that's happening. But this is really weak. Real estate, even though it had a pretty rough week, I'm at a 0 on real estate. Again, same thing with utilities. Ugly day on Friday, but I want to see a consistent, compelling close below that 50-period moving average before I'm going to get negative on it. This is one that's held up nicely, held up well, and I think people are going to get back into there. But until they do, I'm at a 0 on real estate. Industrials, we're looking at a -2 on industrials here. It looked like it was trying to go up there, but we were at a -2 on industrials last week as well, and we just continue to be bearish on it. I mean, this has got a little bit more room to fall before you hit those February lows, but you're well below the October lows and the March lows that we put in here. So this one is just looking weak to the downside. Looking at healthcare, that's another one that's at -2. It was holding up there pretty good, but that is some serious technical damage done last Friday. And that put us down to a 0 on healthcare, and then the market action this week, we're firmly below the 50-period moving average, and so I'm at a -2 on healthcare, which is kind of I didn't expect to be at a -2, but hey, that's why we trade the markets in front of us, not the ones we think they're going to be or the ones we want. So financials, this one has gotten even worse than was. We were at a -2 last week, and we're at a -3 on financials. And like Rob said, we don't get to -3s on the sectors very often at all. And, we usually stay mostly between that, +2 to -2, depending on what's going on. So to see this many sectors at a -3, this is what we're talking about in the extreme cases. Ride it to the downside, but you should expect a pretty significant bounce when things get this extreme. Consumer, we were at a 0 on consumer last week. We're at a -2 right now. This is at the lows. This looks like it wants to break through those lows, which is a little bit surprising because consumer made a really strong run. It looked like it was trying to hold in there, but just couldn't. Fell back down to those March lows. So this might be support, but it doesn't look like it, and we'll find out next week. But we're at a -2 on consumer right now. Tech is another one, -3 on tech. We've got that 2050 cross right there. We're firmly below both. We tried to rally a little bit on Thursday, and then we lost it all. Lost all Friday. We're still kind of at those March lows. You take a look at Tuesday's candle. Did we decisively break those? Not really, but this is looking pretty weak. And I think any close firmly below 140, you definitely have to say that nobody is looking for tech right now. All right, here we're at materials now, and we're at a 0 at materials, and this looks a lot like energy does. You see last Friday's candle, what had been bullish, put it firmly to 0 right now. A lot of really volatile market action here. I'm at a 0. I want to see, like I said, a firm close below that 50-period moving average before I get bearish on it. We looked like we had some strength on Thursday right there. This is one that looks like it just got caught up in the market action on this Friday. So, let's see what it goes, but I think, it's 0. You could also, depending on your criteria, make an argument for a -1. I would have no problem with that, but I'm in wait and see mode. Finally, energy. This one, we're at a 0, and we're just going, if we're pegged between the 20 and the 50, I immediately look to say, okay, we're going to go sideways. I'm in wait and see mode right now. But this is actually one that's held up pretty good. So you could also make me the argument for a -1. I wouldn't have a positive one. I wouldn't have a problem with that. Right now, again, I'm in wait and see mode. So let's see how things stack up, and you're going to see really it's stuff that's holding in there, energy, real estate, utilities, materials. If 0 is the best you can get for 40% of the market, then you know that things are pretty weak. And everything else, industrials, healthcare, consumer at -2, tech, financials, and comm services at -3. Here's what we mean by the extremes in a lot of the analysis that you do. It looks like we're going to bounce back at some point in the very near future. So let's take a look of a couple of potential trades. We want to go over last week's trade. And last week we didn't do one in utilities. We did one in real estate. That was Prologis. We were long, but Prologis was down, 5.35%. So that's fine. If you got into it, you're definitely in a defined risk trade. Just sit through it, because this has been a fairly strong sector. But for utilities right now, we've got Vistra, VST. It's in a nice bull pullback. It's held out nicely. You can see that, even though it had a red candle on Friday, it's still fairly strong. We're still above that 20-period moving average. This one's held up pretty well. So we're looking at the May 20th, 25, 26 bull call right there. It's a utility. Don't expect a whole lot of movement out of it. But this takes us out. It gives you a good 3 weeks to make a dollar run. I think it's going to be pretty good. You probably get into this for 40 cents. And so you got 60 cents to the upside, maybe 45 cents. So this one's looking pretty good. And communication services, last week we had Roblox short, and Roblox took a bath last week. They were down 10.77%, so we're happy to be in that trade. That one definitely triggered and took advantage of it. So this week we've got Zillow, and I remember when this was perennially to the upside, and for the past couple of years it's been perennially to the downside. Even with a hot real estate market, this has not looked good. So you can call this a low base, you call it a march of death. The last resistance that we broke was 46, and we've drifted, come down very quickly all the way down to 39. So we had 6 points of downside in about a week and a half right there. So this is one I want to be able to sit through some volatility. I want to be able to sit through any type of bounce that we get. So I'm going to be looking at that the May 42 puts, and I'm going to short next Friday's 38s against them. You could even go down and short the 37s if you want, depending on where you want to go. But that gives you a little bit of, if we just base here, you're going to looking pretty good. If we break below 38, just take the whole trade off. You made a little bit of money and move on. So in healthcare last week, we had Bristol Myers long. And this is going to be a position that we're going to be happy to keep, because with all the market action, Bristol Myers was only down 0.6%. So if you're in that trade, I would not worry about that. You've already put your max risk in there. Let that one run. I would not poke that one at all. This week in healthcare, we've got Johnson & Johnson. It's in a bull pullback again. It's right at that 20-period moving average. So you're going to wait for confirmation on this one. And waiting for confirmation is maddening at times, but it's something you need to do, especially if you're going to go long something strong in a very weak market. You need to wait for that confirmation. So you'll be long the May 180s, and you're going to short this next Friday's 185s. Again, depending where these strikes may change, depending on where you get that confirmation that the bull pullback is over. But take a look at those, and initially that's what we're going to be looking at. The 180, 185 diagonal call spread.
In industrials last week, we actually had Builders First Source, BLDR. We had it short, and it did not go down, but it also did not go up. It was up 0.2%. So, sometimes they work for you, sometimes they don't. This one has some more time left to go, and so I do think this one will likely be a profitable one. But we'll see. This week, we've got Plug Power. Right, now Plug Power, this is one of those stocks that's been around forever. And I remember when I was going to AT&T to get something done with my phones, and my phone's under my business account. He's like, oh, trading, Maverick Trading, what's that about? And so he's like, I'm doing trading. He's like, I found this new stock called Plug Power. And I just laughed. I said, look, I was trading Plug Power back in 2001 when it went from like $5 up to $90. and then it went back down to $5, and it's gone to $90 several times over the past 2 decades. This one has been hot, and you can see now it's cooling off quite a bit. And this is one of my favorite little patterns here, where we see lower highs, where it's just sloping lower. It's trying to hold, but it just keeps getting lower, likely going to break. I like this one quite a bit, and I'm looking at the 2022. 2022, I'm probably going to get $1 in credit, so it's a 1-to-1 risk reward, but this is a really easy one. It's a 1-week trade. If you want to go out a little further, you could take a look at the May 20th diagonal put spread and sell that 20 as well. Financials last week, we had Marathon. So Marathon is a cryptocurrency, Marathon Digital Holdings, and they were down 14%. We had them as a short, so great trade. I know that we had a bunch of our traders that were either short the crypto names or the crypto ETFs or whatever it is. The crypto is likely going to head significantly lower from here. That's been our call for a while. So we'll see what happens. This week, we've got UBS. All right, UBS Bank. Here we see a stock that has had a huge range, 15 to 21. And we had this massive run here, and then we fell back down. So as you can see, we're basing here right around the 17. A break of this base, and I think you can say 15 is possible. Now, I'm not going to get that crazy. I'm going to look at 16 as a target and say, you know what, I'm going to sell that 16, 17 bear call spread. I'm probably going to get about 65 or 70 cents on that, which means I've got 30 cents of risk on the trade. If you want to be more directional, go with the straight puts. Go with the straight May 20 puts. Once we get that plunge, that capitulation, that's the exit point. That's the exit point. Take those profits and look to trade elsewhere.
In consumer, last week we had Cisco long. And that was down a little. It held up pretty good compared to a lot of things. It's down about 3.75%. So we're going to let that one run and just let it go. But in a market like this, to hold up like that, we're happy to be long something like that. This week we've got Philip Morris. We're going to call this one sideways. We're looking at the 95, 100, 105. Call butterfly. You could even do put butterfly. It's the exact same risk graph. But we don't think we're going to get a whole lot of movement one way or the other. We're right at that perfect strike right now. Going out to May. This one's going to run on time. So size it for max loss, and this is not a targeted butterfly. This is a butterfly at the money, and you size for max loss and let it go to expiration, and then make sure you take care of the whatever leg is in the money at that point. So we're liking this sideways. We tend to get a little directional at times, so it's always good to have someone be sideways. In technology last week, we had SentinelOne short, and this is another one that it looked like it was good for a short, and the market gets a vote. And so SentinelOne was up 1.81%. We take it, we've sized it for max loss. We're just going to let that one run. This week, we've got Sabre Holdings. And this is you call it a high base, or it's hanging in there. And you got to remember, in a down market, anything that can hang in there is by definition strong. So if we have, and this is held out there, between 10 and 11, or I guess it's at 1050 right now. It's pretty narrow range, but with the market action that we've had to be in that narrow of a range for this, yeah, we're quite happy to take a look at something like this. So I'm going to go out to June. Believe it or not, we're looking at June calls right now. Go long the 10. I'm going to short May's 11. And so I'm giving this a little, about 3 weeks to run. But we're happy to let it go. We just think it hangs in here, and in the next 3 weeks that it's going to be somewhere in that range. I'll reevaluate in 3 weeks as well.
And Darren, I really like this trade you have because technology is a -3, and we've been short technology really since November. And at some point, that trade is going to run its course. These trends can last for very long. I mean, we had downtrends in 2008 for almost a year. So, but we are anticipating a bottoming out at some point. And so by starting to pare back on the things you're shorting in these really overextended sectors, and even start dabbling a little bit on the long side of the stuff that's really held up, I really like this trade in the fact that you did a diagonal to where even if this thing just hangs out, you're happy. You just want to see it hold above 950 is really what you're looking for. So I like that one. In materials, last week we had DuPont short. It went down 2%. So it was better than the market. It was still a nice little drop, but I think this one still has some more to go. This week we're going to be taking a look at Freeport-McMoRan. Now, when I was putting this trade together, I looked at the name online and I'm like, wait, why is the R capitalized? What? That's surely a typo. So I ended up getting down this whole rabbit hole on this stock and this company and reading all about it. Now, look, they're a copper miner. They own lots of big copper mines. But so this is a combination of three people, MC, MO, and RAN, that actually started that part of the company. They used to be separate companies. Okay, you know what? Go read on your own time. You're here to get some trades, so that's fine. This one is our belly flop pattern. Now, for years and years and years, I called this pattern the first stage downtrend. And I thought it just doesn't roll off the tongue. That's not a great, sexy name. So I actually brought this up with our traders, and they said, hey, we need a better name for this. And we got the belly flop. And I love the name. And it's really indicative of what has happened here. When you have a high flyer, something that has been very, very strong, and it's just cranked higher and higher and higher, and then you get a break on really big volume. Now look, something happened here. I don't know what it is. Maybe it was an earnings. I have no idea. I don't care. But what happened here was all of a sudden, anyone who wanted to buy it said, no more. And so what happens is these things plunge down and they base. And they base there for a week or two, and then they make some new lows here. So I do like this pattern quite a bit here. So the big question is, where do you go to? I'm going to 36. 36 is my target. If you want to be in a spread to where you can sit through volatility, sit through all this stuff, then I think the May 36.40 bear call is the one to go. You're probably going to get $2.80, $2.90 of a credit, $1.10 of risk. I like the trade. If you want to be a little bit more aggressive and be able to really get in and out when you want, just go with the straight puts, the May 45 puts. That is Freeport-McMoRan. And again, the R is capitalized. In the energy sector, this was a tough one because we saw on Friday everything got hit. Even the stuff that was like holding up, even the stuff that was like, hey, you know what? There's supply chain issues. There's orders for this company's product for the next 10 years. They're not going down. Even those went down. And it reminded me of a saying that in the market, when the market's crashing, sometimes you can't sell what you want to. You have to sell what you can. And so if you take a look at, all these losses that are happening, and these funds say, hey, we need to raise cash because we're going to get some requests for distributions. So they just start to sell even their winners. They sell their winners. They sell everything. And I think that's what we're seeing here. And that's what usually happens at the extreme points, is you start to get this cascading effect. The things that held up, they start to come down. So energy, I really like energy here. I really like it. But here's the problem is that I think over the next week, it's kind of dicey stepping in to make a long here. So I wanted to find something that was lower volatility, which is ExxonMobil. And I want to find a strategy that is really just pretty boring to where you can just sit through it. So I'm looking at the May 85, sell this week's 90. And if that 90 is not worth enough, maybe I'll sell the 88. This is a really wimpy trade. But this is a slightly bullish trade here on ExxonMobil. And if it doesn't go down below probably, let's call it $84, 83, I'm probably above my break-even point and going to make some money. Give yourself enough time to let this one work. I think this one, again, the whole energy sector could be shaky for the next week. We could see some plunges. But I think if you're able to go out enough time, I think you're going to be just fine being long energy. That's our trades for you. If you have any other trades you want to share with the rest of our trading group, go to Maverick Trading, log in to the members area, and share your trades. We always love when our traders have full-on discussions there. So to wrap this up, support is broken. You know what? I have to say, sort of. It's give me one more candle. But the momentum to the downside was very brutal on Friday. There was no bottom, and we even accelerated into the close. There's likely going to be more selling at the open. I would not be surprised to see a gap down. We are reaching extreme levels. And so when we get there, again, I want your hair on the back of your neck to start to go up and say, okay, I know what happens here. The markets freak out. We freak out to the downside, and then we'll freak out to the upside. Just like when it does it on the other side. When the end of a long bull market, it has that blow off top, and then it tanks. We're at those levels. So we are getting much, much closer to possible reversals. The way to survive these all, position sizing. Proper position sizing. We preach that all the time. Make sure that you are in enough trades to where you're diversified. You got longs, you got shorts, you got some sideways stuff going on to where you can sit and weather through this volatility. That's it for us. Thanks for joining us. Have a great weekend. Goodbye.
Thanks, everyone.